How about that? We are now moments away from the Fed releasing its latest decision on interest rates.
That's right. The Fed's expected to hold rates steady once again. Rates have remained the same since the Fed's meeting last July. Economists are not expecting a rate cut until probably September at the earliest.
CBS News contributor J.D. Durkin is over at the New York Stock Exchange following all of this for us. And with us here in Studio 57 is Javier David. He's a CBS News contributor and the managing editor of Business and Markets at Axios. Javier, let's start with you. Why are we not expecting a cut once again today?
So the Fed wants to see the whites of the eyes of disinflation, or at least sustained fall in inflation before they're ready to cut. And believe it or not, they actually do want to cut, but the data is just not giving them permission to do so. So in order for that, we've written about this at Axios a lot, but they really need this sort of permission. And until very recently, the figures just haven't given it. We've gotten all of this data that's just sort of this run of data, which is better than expected or hotter than expected. And that's just not what you want to see if you want to begin an easing cycle, especially after this sort of inflationary spike that we've had over the last 2-3 years already.
JD, I want to bring you into this conversation as we're thinking about investors, as you're watching how they are so actively listening to Fed Chair Powell's speech, which will follow the announcement of either I think we can go ahead and say what is very likely to be the rates staying the same. What are you hoping to hear from the Fed chair?
Well, I think a bit of clarity on the path forward with regards to monetary policy is something that all investors eagerly want to hear. And of course, this comes on a day of a very rare double feature, as my friend Jay Woods at Freedom Capital Markets put it today. Meaning earlier this morning, we got CPI inflation data, and Lana and Errol and Javier, we don't frequently get CPI data on the same day of a Fed announcement. So, I'll be looking forward for a lot of those question and answers. What do Fed officials need to see to gain confidence that, if not in July, maybe September, as Javier was just saying, maybe that is the path forward to lower rates. And I'm also looking for questions to the chairman in the next half hour or so about how this FOMC, how the U.S. Fed is being informed by the decisions of the European Central Bank as well as the Bank of Canada. We can't forget, we got central banks all around the world that are also manipulating their own interest rates in their own regional fight to get inflation. And we've already had the Bank of Canada and the ECB begin their rate cutting process. To what degree will U.S. officials sort of take a page out of the book of some of those others? And certainly we'll learn a lot more when Chairman Powell takes to the podium in about 30 minutes or so.
And JD, as we wait for the Fed's decision, let's talk more about the connection between the Fed's decision and what's happening in Canada and in Europe, because the data there is a bit more generous in that it's allowing them to pull back slightly on interest rates. But we haven't seen that yet here in the U.S., to Javier's point, because the data's not informing that decision. What's the disconnect?
Well, we also can't forget that, different central banks have different mandates. Right here in the United States, the Fed has a mandate both on jobs as well as employment as well, and really stabilizing prices as well. That's not the same mandate that other central banks around the world have. So if we do see a bit of a disconnect, maybe Chairman Powell and his colleagues at the FOMC could say, well, hey, with all due respect to our colleagues over in Europe, we have a unique set of mandates here in the United States. But even though we do have CPI today, we got PPI inflation coming up. We are just a few weeks away from the central banks, the U.S. central bank, that is, preferred gauge of inflation. That's PCE, personal consumption expenditures. That comes out on June 28th. So it'll be a lot of kind of hurry up and wait. We try to see. We know that the Fed is going to say we remain data dependent. We're going to take one data point at a time. So if there is a bit of a disconnect between some of the actions we've seen from other central banks, like in Europe or other countries around the world, I would expect Fed officials here in the United States to remind investors at the press conference that this particular Fed in the U.S. has a unique set of goals to go about that other central banks, quite frankly, don't really have to worry about.
And I'm looking at the Fed Reserve's statement that they just released as we've been on the air talking about the committee deciding to maintain their target rate for federal funds at 5.25% to 5.5%. And they said that when they're looking at this, they're really trying to balance risks. So, Javier, when you're looking at the Fed's task ahead of them, what do you see? Does September still look like a viable time for
September
cuts?
is the most likely time. Everyone wanted it to happen like this summer. It's not going to happen, especially with the data that we have. So there's this whole debate because, A, stocks are at record highs. You've got Bitcoin, sort of, it just bounced off a record high not too long ago. All of the asset classes that would actually, like, should be on the way down because rates should be restrictive, are rallying. And so that has raised the question about whether rates are restrictive enough. And you have to also look at the data that we got today. It's encouraging because it's, you know, we're creeping more toward disinflation, but still well above 3% and well ways from that 2% magic number that the Fed really wants to see, which is their target.
Right.
We're not even close to that. So that's what the Fed is really looking at. Like, how long can we get something that resembles a decline in prices? And of course, whether or not can we get anywhere close to 2%?
And that 2% objective, obviously unchanged, very first thing that they say in their statement. Is there any possibility that the Fed might adjust that target goal?
This is the debate. The short answer is no. They really do believe that, you know, this is a long-held, cherished central banking tenet of price stability, and that is what it takes to achieve it. But, you know, they can do a couple of things. They can, you know, one of the things that we don't talk enough about is the quantitative tightening, which is this whole process of them sort of winding down their balance sheet, which tightens financial conditions. And they really want to see, that's actually a really important indicator. Just the tightening of financial conditions, stocks really shouldn't be where they are if rates were restrictive enough, but they're at records. And so that really just kind of encourages people to keep spending and encourages, you know, companies to sort of shell out money, even though we're kind of in this weird position where companies aren't hiring a whole lot, but they are also not firing a lot of people. And that's why the labor market, in fact, has remained pretty buoyant.
And so if you're just joining us, we're just covering this news of the Federal Reserve holding interest rates steady with Javier E and J.D. Durkin. This was as expected, J.D. In the statement released by the Board of Governors, they also mentioned that they will be reducing holdings of Treasury securities and agency debt and agency mortgage-backed securities. What does that mean? How does that fit into this decision today in the bigger picture?
Yeah, well, that's what my buddy Javier was just talking about there a moment ago, this idea of quantitative tightening. I mean, we can't forget when the COVID pandemic first hit, you know, in an effort to sort of inject cash and liquidity into the system, the central bank really went on this unparalleled run of scooping up treasuries and mortgage-backed securities. A lot of accusations there, the Fed of sort of printing money and injecting it into the system. And kind of quietly, to Javier's point, has been on the system of unwinding that, or really allowing those treasuries to fully mature without replacing them back into the system. And it's honestly a really important component, to Javier's point, of what the Fed is actively doing, but it's not something that we frequently talk enough about, especially because I would argue this interest rate movement or straight up monetary policy, I think for the right reason, obviously dominates much of the conversation. So I expect we'll get more questions in the question and answer portion to Chairman Powell about the decision of ongoing monetary policy or the quantitative tightening. We also can't forget, economists are still kind of split about really what the effects are of quantitative easing and quantitative tightening. If you're confused, if it sounds wonky, I trust you, it's not alone. You ask 10 economists what quantitative tightening really does to the system, you'll probably get 10 different answers right now. It's
probably
something that was
20,
kind of
actually.
Probably 20. Yeah, they'll each give you at
hand,
least 2, if not 3 different rationales for it. It's something that the Fed has not been doing for very long, and we still don't actually know what the full effects are. We'll hear what Chairman Powell has to say in the next half hour or so on that.
J.D. Durkin, Javier David, thank you both.
Thanks, guys.
Thank you.